Hi, good morning. I know I'm coming after a long time, but again, I think last time I was telling that, okay, this is not something my main area of business interest. I'll try to, impact whatever I know when I get some time. It's slightly cold in Bangalore, so not very cold, so you might find some bit of oddity in the voice early in the morning. Anyway, let's come to the subject. One of the reasons why I decided to go live today morning, it's not about live actually. I wanted to share something with you guys. Is basically, for last 30, 40 days, right, or a month or so, I'm carrying some of the biggest derivatives in my life. When I say biggest, it's not in comparison with markets, somebody else. I mean, see, size matters, up to your individual risk appetite. Right. So, see, for a person whose net worth is, say, 100 rupees, right? 20 rupees can be a significant size. So, the simple reason is because, if he goes wrong five times in row, then he's bankrupt. Anyway, so basically, these are sizable future options, which I opened onto the short side. So, basically, still I'm short. Okay. So that's the kind of experience I have felt in last 30 days. You don't get them on theory, so that's a problem. So we'll touch upon some of those subjects that, okay, by going through any training classes, coaching classes, can you turn to be a good trader? Well, answer is both yes and no. I mean, I won't take a single direction like lambasting those guys, who are doing trading or trying to support them blindly. No, it doesn't. So you need a mentor, you need a teacher, but it does come with plenty of caveats, right? There are do's and don'ts. So let's understand this. We keep hearing this word trading and investing, right? And in India, it's very very popular. In US, they do use the word trading and investing, but I think these were the subjects they were covering in 80s, 90s. See, traditionally the fundamental difference between Indian markets and US market is they are more mature. There's no doubt about it. I mean, because they have seen this bull markets, bear markets from 1920s and all that, right? So we did have a stock market existing even in those periods, but we didn't have that liquidity. We didn't have that kind of market making functions, right? We didn't have that participation also. There was no regulators, as you know, till 1992, right? Security Exchange Board of India came in 1992 after Hassan Mehta scam, right? So, in a sense that, okay, we are observing the same phenomenon what Americans used to observe in 80s and 90s. A plethora of training courses. Then, there is a big debate around future and options. Even there is a larger debate around what is trading and what is investing, and obviously the training classes, right? Then more hyperactive regulators. See, now every day you open your trading account, there will be a window saying that, okay, 90% people are losing money, but still it doesn't bother. It's like you are smoking a cigarette, which comes with a person will be having a cancer and half of the portion is gone. Does that made people stop smoking? Answer is no. Okay. So anyway, that's not our job. So let's understand what's trading and investing. So trading is again, trading as a normal nomenclature is somebody who keeps the inventory, who keeps the product, okay, and sell it for a profitable value, basically a markup. Meaning, I get some 100 items of XYZ, right? From whatever sources, from the manufacturer or from somebody else, let's say, 20 rupees. And then obviously, I need to store these items. I need some people to sell these items. I need to have some people and infrastructure, to support after I sold. So the whole idea is that, okay, I don't keep them for my own consumption, okay, and then I expect to make some profit, basically doing a markup which covers my original price plus the associated cost. Meaning, if I got a 20 rupees X product from somebody, some say, factory, right? And my cost per unit is a 50 paisa. So that means, my landed cost is around 25, 20.5, which is basically called, cost of goods sold for us, right? So then, as long as, I sell above 20.5, then I make profit. If I can't sell, then I make a loss. So that logic is slightly, flawed when it comes to stock markets. If one is that, okay, you are not buying, what you called, okay, so you're not buying a fixed value. That's one. Of course, even no inventory is fixed, but they do have a trend. Here, every second, things moves, which is a perception value. See, what price you are paying is your perception for a stock, which may sound high to somebody, may sound low to somebody. That's why people buy and sell. We have spoken about a bit about, last time also. But let's understand, what are the argument that goes on when people say that, okay, trading is short term, right? That's what you keep hearing. Right? Trading is short term, investing is long term, right? And then there is a second school that, okay, who will argue that trading is risky, okay, investing is safe, okay. So let's examine these two statements. Don't go further. So we said trading is short term and investing is long term, right? Well, answer is no. This has nothing to do with the short term and long term. I think, I was explaining you before that, okay, if you go by classical definition, here is the thing. So any stock you purchase, right? Once you buy, then within a day it get deposited to the depository account. It's a CDSL or NSDL, whatever you're using. Largely we use CDSL as retailer, right? So once the shares are credited to your demat account, that is CDSL, it basically recognizing asset, right? So based on that recognition, income tax defines that, okay, less than anything is short term, more than 1 year is long term, right? Less than 1 year if you sell, it is short term. More than 1 year if you sell, it is long term. But that's a classic tax definition, to tax at a differential tax rates. Does that analogy applicable here? Well, no. So here is this way, if you you buy a stock, okay, after doing a lot of research. I mean, you don't want to, buy for 2 days, 3 days, and all that. You think that this is a good company, I'll hold on for next 5, 10 years, and all that. Within 2 months, you realize that, okay, something has gone wrong, either with that company, or you feel something has gone wrong with the market. Will it be prudent to hold that stocks, which the principal loss is more than 40%, right? Or 30%, 20%, whatever. So these are the questions. So it's not about thinking that, okay, I am buying XYZ company, so I should be long term. Because I have not done the research, I'm using some. See, another flawed thinking that goes around is that, okay, traders buy on some, goddamn technical analysis or some macroeconomics and all that, or maybe flipping a coin, whatever other things get discussed, right? So you have a plethora of YouTube, where people goes draw some fancy lines and charts, and they say, if you buy this, buy that. That's called as trading, right? At the same time, and somebody who is savvy, writing well, writing about fundamental balance sheet, profit loss ratios, future growth prospect. The guy is reading director's report. It's called fundamental investor. No, both are wrong to me. As an experienced practitioner, coming from the backroom of the industry, as well as an individual investor and trader, my opinion. See, there is nothing called conclusion here. Okay, my opinion is totally different. So it doesn't matter, trading or investing. Trading and investing more is a classical combination term in income tax. So what is more important is what are the key factors behind speculation or other marketplace. See, when you come and buy a stock, it is basically, you're coming to marketplace. Last time we spoke about it, right? So there are three parameters that works. Okay. Uh, One is okay. So sorry, I'm sorry. So how do you know that? Okay, are you doing well or are you doing bad? It's simply there's something called metrics. See, balance sheet is the positions of assets and liabilities for a company. That's nothing but a matrix, right? Similarly, PL is a matrix. Similarly, your salary also is a matrix. It just shows the earning capacity. It may be correct or incorrect, but that's a hard recorded number, right? So here, what is metrics? How do you know that we are making profit? Okay, so only by taking buy price and sell price and the difference with the cost, that does not show the true picture. So one must understand that, okay, what kind of metrics that needs to be prepared, right? And then once you know that, okay, what are the kind of metrics to be prepared, what are the key factors that is driving. See, this is a very very long drawn subject. It requires self-reading, it requires a bit of homework. I will drop you with some books name and all that, but I don't think we can cover everything. I'll just give you a brief, so that, see, my idea here is not to explain everything so that you become do it yourself. That's not possible. So do it yourself is a concept that, okay, you have to do it. You have to cut a tree, you have to pick up one scissor and then go and try yourself. Okay, so here's the thing. So typically, speculation or investing or a trading metric. Let's use, see, speculation somehow is considered as some evil force in our day-to-day life, but that's how the words are bombarded in television and media space, right? Answer is no. Speculation is part of your life. See, if you're walking out of your home and driving your car to 3 4 kilometers or wherever, right? This is also speculation. You don't know. You might met with the accident. You might have a breakdown, or maybe it started raining. There can be many things you don't know. You don't factor them. Yeah, there are some informations in hand based on that you are doing. That's exactly stock market. So when you drive your vehicle, in a sunny day, you don't expect rain, right? Because you see weather forecast, right? You see the sky that, okay, everything looks good. Then you feel that, okay, I'm going to come back in 3 hours. There is a chances of rain is minimal, less, right? But can you be foolproof? No. You'd have realized, on some odd days and all that, suddenly, from nowhere the rain started, right? So that's what market is. So you prepare yourself, you go there, right? You have your probabilities on your side, like you don't dot it down that, okay, this is how the market is behaving, this is how the stock is behaving, this is the company, this is the management, whatever, right? Then you feel that, okay, the lesser risk is on my side. That might result in higher rewards. Okay, so this is a very very important statement. Your focus should be towards reducing the risk, not enhancing the reward. So let's understand this. I mean, if you remember last time I was telling you, read market visits, where you can see hundreds of some of the finest traders and investors of the world, who was giving an interview, right, to Jack Swagger. So everybody focus on risk, because if you manage risk, meaning the downside, upside is kind of automated. See, the fundamental fact, if you are involved in market, you will realize that, okay, market goes up and down without your control. Okay, so if the particular share price is trading at 100, to go up to 105, it just needs few buyers and sellers and a force that can be irrational, that can be stupid, but you can't control them. It's the larger force. If they're more powerful, they have more quantity than you, they will drive the price up and down. That's the ground reality. So as long as you are wrong, you accept that, you cut it down, then you survive. Now these are very very rudimentary words, right? Like they use the word stop loss, right? So somebody will say, okay, stop loss, put it at 3%, 4%. Somebody will say at 10%. There is the fact is there is no answer. Depends on your style of investing. Depends on the holding period. Depend on your capital. Depends on your lifestyle. There are many things are there, right? So, but mathematics is something which works. Okay. So I will leave you with a word. which is a magical word, for anyone. I mean, traders use it, but it is applicable for everyone. So your trading or investing both, requires a simple metrics, but wait, which is very very powerful. Okay, expectancy multiplied by opportunities. Expectancy multiplied by opportunities. These are mathematical terms. So what is expectancy? Expectancy is, you are creating a system, you are creating a process, you are creating a method which has a chance of making positive money out of the system. Okay, I mean, you see, you're building a project, you feel that you're going to make some profit. How you're going to make some profit? You have your own background workings, right? So now, if you build a project, which never gives you profit for whatever foreseeable period, will you be interested to start some kind of project? So, what is expectancy, or a positive expectancy, for a trader and investor, right? So, it is largely accuracy into margin. Okay, so all these formulas you will get, most of the trading mathematics books will cover. Okay, so accuracy is that, okay, what is the percentage of time you are winning and what is the percentage of time you are losing. So if you're taking 100 trades, if you win 40, 50, 40, 50, 60%, then it is 60, 40, 50, 60% is the margin. Accuracy, sorry. Right? The second aspect is every time you are winning, how much you are winning. Okay, and every time you're losing, how much you're losing. So now you might find that, okay, this technical indicator, that indicator, all that, right? They'll say that, okay, 90% accuracy, 80% accuracy, right? So you think that, okay, you need a model which gives you 70, 80% accuracy to make money. Answer is no. It is actually the contrary. So, okay, let's talk, the practical things. The world's best trader have an accuracy rate around 40, 45%. Okay. So including the titans like the Jim Rogers, Paul Tudor Jones. I mean, you pick up anyone, William J. O'Neill, right? So possibly the only guy who apparently before 1929 they say it's around 60% is Jesse Livermore, one of the greatest traders of the world. Of course, that's another story. So someone arguably the best traders of the world, they do have accuracy of 40%. It means 40 times they make a profitable transaction out of 100 transactions, and they're still billionaires and successful guys. So, so what happened to the 90% accuracy? Right? See, the beauty lies with how much money you are making every time when you win. Okay, so now if every time you win, you make 5 times more money than when you lose, right? Suppose I'm making 200 rupees every time I win, right? And then I'm losing 40 rupees every time I lose. So basically, you're making 5 times of your losses, right? So then the profit started flowing. It's natural mathematics, right? Now you will realize that, okay, making 200 rupees and losing 40 rupees is also a function of two other things, size. See, to make 200 rupees, if you put 200 rupees capital and you expect 200 rupees to make, right? It may or may not happen because the market forces getting 100% return in a shorter period is not that difficult. So now we'll attach one more element. So your expected returns in terms of percentage and the capital depends on your gratification period. That means the holding period. Also on the size. See, if the stock is moving 5% in a day, which is happens all the time. So now, if you have say what are that 4,000 rupees, and then then goes up 5%, then you make 200 rupees, right? So, but that 4,000 rupees capital may be higher or lower. Then second is that, okay, the size is higher, the downside also can be equally higher. So this is a classic combination of balancing between money management, risk management, and psychology. So these are three fundamental pillars of investing and trading. A lot of people, they just got carried away saying that, okay, buy, hold, forget about it. Answer is no. See, money management again, risk management and psychology. they are applicable for everyone because they are mathematics. So there are two major components which are mathematics. The third component is a philosophy or a psychology. It has nothing to do with stock market. It has nothing to do with investing or trading. Okay, so what does money management? Money management makes sure that when you win well. When you lose decently. Risk management is that how you're going to protect your downside. Psychology is that when the numbers are fluctuating, meaning that when you are in a drawdown or your money is going down, how you're supposed to behave, right? How you make your composure, right? So because psychology plays a very big role. See, psychology is only applicable when you are involved in the market. If you don't have a skin in the game, there's no point talking about psychology. Okay, so though these are formulas, these are philosophy. Money management, risk management is pure formula. The problem with the formula is that you're putting real money, right? You get real experience. So all these you have to note it down, right? Prepare your own metrics, review them regularly, and see that where things have gone wrong. I mean, for example, can my size be more optimized? Am I putting a large part of stop loss? Right? Am I holding too much? Then suddenly you'll start realizing that a lot of these components are also linked to external factors. Like if you don't understand the market cycles, how it's work, suppose if the market is in a so-called proverbial downtrend or a sideways, and you are trying a lot of positions, it's not going to work, right? So, but you again, what is downtrend and what is uptrend also depends. What is your time period. Somebody who is holding a swing trade of 4 5 days, I mean, any market, bear or bull, they will get some time, right? So this is, you will realize, you will learn more by reading your own footprints than reading somebody else's book. That's what I'm saying. See, even if I keep on going every week here, and I can't do that unfortunately, but if I spend even 60, 70 minutes every week, twice, and all that, right? It may give you some guidance. The best learning it comes from read your own footprints. So, what is your own footprints? It starts with metrics. It's the results, right? The key performance indicators. What is my largest loss? What is my average loss? Right? How it is improving over a period? Right? What is my account value gain month wise? Right? What you call that? Okay, how many times I have taken the trade? What is my average turnaround period? Okay, so this is a long subject. You have to do your own back work. Okay, so I'll give you a couple of books to enlighten yourself. One is Trade Your Way to Financial Freedom. That is by Dr. Banthorpe. Universal Principles of Trading, Brain Penfold. Okay, Trade Your Way to Financial Freedom by Banthorpe. Universal Principles of Trading by Brain Penfold. Then, of course, you can read How to Make Money in Stocks, which I told last time also. That gives a lot of insight to money management, risk management. The Mark Miller Winnie both books. Okay. As theoretical books, I think they are decent enough for a starter. He does talk about risk management and money management, and of course, market wizards have balls of wisdom on what is money management, what is risk management. So I think this was okay. I'll conclude. Trading, investing, and blah blah on that is. You will realize that trading, investing is about your mathematical success. It is not about holding long or holding short, doing fundamental study or not. Okay, because when it comes to fundamental study, that there will be two schools. One school which try to gather information already recorded and existing from the balance sheet PL, and then they try to assess that whether the company is available at a price could have been more in the financial. That's typical the value investors, right? The value that is reflected in the market is much more lower than the intrinsic value of the company. There is a second category of investors which are very, very popular, in these days, and they're going to be there actually. One of the reason is because the technology is changing a lot of things. So these days you don't buy these, what are called fad companies like Zomato, Swiggy, Paytm, I don't know what all, right? Not because they have a higher intrinsic value in the financials than what it is reflected. In fact, these guys are trading at some of the all-time high valuation. So then why there is a craze? That's because of the growth. So if you know that, okay, these guys want to control 30% of the market share in the whatever product or services they're selling, right? Obviously you know the potential. So then the market will discount that. They won't bother about what profit you are making initially, what business you are doing initially. Now this valuation will collapse if none of these theories are played out. So with this, you will realize that, okay, value investing offers you a lesser risk if you time with the market cycle than the growth investing. Growth stocks are irrationally, priced most of the times. So now something goes wrong, they can collapse like a pack of cards. Value investing, on the other hand, because by definition, by nature, they are already have got a proven track record coming from the financials. So as long as you are matching these two components of financial valuations with the market valuation, you will be reasonably, managing the risk on the lower side. But saying that market itself is irrational, sometimes it can fall and then you can collapse. Okay, so you read these books, learn about expectancy, learn about accuracy, learn about metrics. Okay, I do prepare metrics for many years, and in fact, one of the biggest strength of the financial institution is actually metrics. Okay, so see, a lot of these things, financial institution and asset management company they do at the back end, they don't uh, sell outside or people don't know. See, let me tell you something here. You would have realized that, okay, when you open the YouTube or anything, right, you will realize very few people. I haven't seen many actually, right? So maybe it's like one in million maybe. So largely these trainers are they never worked for banks and financial services, right? I'm not talking about retail bank or corporate bank. I'm largely talking about the investment bank. Those guys who are supposed to deal with the markets, right? Capital markets. So now look at this. You are going to a hospital, okay, and you're meeting a doctor, taking appointment with a doctor. Doctor is everything but not MBBS. Is that possible? Will you go to a doctor who does not have an MBBS degree? Answer is no. You will flat out say no, right? And that's the minimum thing you expect. Then you ask for specialization. Then you ask for numbers of years of experience. Then you ask for the success rate. Then you take the validation from other people. How is the doctor, right? So why don't you do that due diligence when you take a training from somebody, right? So here the problem is what? A doctor is not restricted to impact his education on public space if he wants to. See, doctors are busy, they may not come on YouTube or anything to explain. And the second thing also, he can't do a surgery or diagnosis blindly, sitting on YouTube. But again, you will find plenty of general information on eye, kidney, heart, wherever the other organs, other diseases are, by very reputed doctors. I mean, Apollo Hospital have their own channel, Nana Hospital has their own channel, and there are a lot of free materials as well, right? So why that's not coming from the financial institution when it comes to the stock market? Simple answer is it is prohibited. So anybody who is working in deal days or the investment bank or the capital market operations or the private equity, they are not supposed to have a public posturing. They cannot talk anything about any price sensitive information on any of the public media platforms. So they are silent like graveyard. Okay. So now here is a provocation comes on the market, where people wants to go and make money, and the best teachers who were supposed to be right, they are not allowed to speak. So that has created a massive demand of this all this what you call anybody Tom Dick Harry Ram Sham Dam anybody comes and they give advice on stock market and people latch on to it. I mean, I've been saying that for a long time. See, if, the late Mr. Rakesh Jhunjhunwala, right, had he opened an institute, right, I don't think the crisis would have happened. Those guys are busy; they never bothered. The same thing is happening now also. See, some of you will be surprised that okay, I will give you a statistics. Out of 170 odd market wizard profiles, Jack Swagger did. Basically, these are billionaires. Right? Some of the, I mean, they are the biggest successful investors of the world. There might be some few misouts also because some people refuse to share their information or they want to be profiled. But saying that whatever he has profiled, they're just absolutely fantastic guy. 99% they don't have an X account. They don't have a YouTube presence. They don't talk to anyone. See, a person who is busy in making money, is see at the leisure time, see like Paul Tudor Jones, right? When he's not a hedge fund manager, he'll go and do yoga. He'll go and do charity. They don't care about that. Okay, coming here and selling bloody some goddamn indicators, right? So people need to understand this. In the first place, people need to understand. Maybe we'll speak sometimes about it. I'm not getting time. What are the right amount of capital to start? Right? Are you expecting too much? So these are the questions you're supposed to ask. No, people don't ask that. They might have a 50,000 rupees capital. The first thing they want to find out is, some trainer, and then they'll give some, indicator. Then I can build, from that 50,000 rupees to 5 crores in a year. That's how the world doesn't go. See, what I told you that okay, it is the promoters who are driving the show in stock market, right? Like our mighty Ambanis or Birlas or Adanis, whomsoever, right? If stock market delivers 100% return every year, you think Mr. Ambani is insane or mad to do a business 24/7, fighting with the government, fighting with the regulators to set up telecom companies, fiber companies, e-commerce companies. He will come and buy and sell stocks here. They create wealth, we share. Okay, so we do have an irrationality advantage. That irrationality advantage is applicable, the lesser capital you have. Getting my point. So suppose if you have 1,000 rupees capital and you want to come in and out of the market 4 times in a day, you can do it. So now imagine if somebody has to move 100 crores 4 times in a day, it is impossible because his own selling or own buying will go against him. So these are certain things you need to develop yourself. So as I said that okay, the word "do it yourself" is basically that you have to do it yourself. See, you look for a trainer only when you have built up something. You look for a mentor when you have built up something. And I'll tell you that okay, mentor does not come with money. Okay, largely in this place, what I have learned because I have mentors, we don't have any monetary communications or monetary connections. It is more about sharing your work, and that can be real intense. It can't be 15 minutes, 40 minutes of chit chat conversation and all that. Okay, you do go 3 days or 4 days of regular sessions, like those so-called Chintan Baithaks and all that, right? Then you analyze each and every trade, then you analyze metrics, then you note it down, then again you do the course correction. You meet. These are all long-run processes. It just can't happen overnight. So just leave you food for thought. Some books, okay. See, one of the aspect I've realized that okay, if you are driven to the right sources, you will do better than others. So let's take it this way. It's not easy to become a trader. Okay, it's not easy to become an investor. It's actually far more difficult than being getting a job because the entry place is not restricted. Everybody feels that they can come and do it. Is it possible to become a good trader if you are not an investment banker and all that? See, somebody always argues with me that okay, sir, your background, your education, and all that gives you a head start. Answer is both yes and no. But you realize that okay, if we chosen chartered accountancy, that was part of the plan. I could have gone and done engineering because I liked market, I liked stocks, I liked companies. That's how I picked the profession. So everything can be pre-planned. Now, if you haven't pre-planned anything, should you surrender? No. But are you going to become overconfident and think that, okay, because just because I can come and open a demat account, I'll make a hell lot of money by doing this? Answer is no. It's a journey. And one of the major problem I have seen when people, they don't do well because they are not directed to the right source. So you read, as I said, I'm living again with three thoughts. You built your own foundation. The only way to build your own foundation is, read decent, good books. I've given you plenty of books so far now. Okay, build some understanding, corroborate those understandings. See, once you read a good book or a practitioner's book, try to corroborate those terms from Google. That will help you. See, if you read some, stupid, this 3 VM, 5 VM crossover and all that, then start searching in Google. Basically, what you are doing is you are looking for a confirmation bias and a fallacy, meaning, already you are fed up with the wrong idea, and then you are trying to get information for that wrong idea to confirm again. So flip that. Get a good idea from this practitioner books and try and search in Google. So once you build up this exercise, automatically you will find that okay, there are good videos. This might take 3 months, 6 months, and all that, but you will build a framework. Then you start playing with your small money, and getting a mentor is not easy. So a lot of the successful practitioners, successful traders, and all that, they don't want to spend time with us. Even see, again, I don't know. I mean, I don't want to put them in club of those highly successful traders and all that. That will be self boasting. But the fact is that okay, I don't see much inclination to spend a lot of time with people randomly, and that's pretty much applicable for everyone. How many times you have seen Mukul Agrawal or Ashish Kacholia coming into some training classes and give? No, they have much better things to do in life. So I just left you, with food for thought, ponder over, and then obviously, you can drop me a mail. All my job is I can guide you to the good source. Either it is the books, either it is some videos. It's all resources. You have to do it yourself. Okay. So now the second thing, we'll just talk about basics of future options. So what is this derivatives? Okay, so I mean derivative has a genesis, totally different, right? So, see for example, this future contracts were created for the companies, to hedge against fluctuations. See, one of the fundamental, nature of future contracts in the beginning period was to hedge against the foreign currency fluctuations. So if you basically, if you need, 1 ton of say, particular X raw material which is coming from abroad, say United States, and that supply can take 3 months, 6 months, and it's a regular thing for you, right? So now the dollar moves from 50 rupees, 52 rupees, 53 rupees, like that. So you want to avoid that fluctuation because that has nothing to do with the price. See, when you are importing something, the raw material price might be fixed. See, suppose one kilo of certain X raw material is $22 in US. So the $22 value in India can be different depending on the currency rate. So you go into a future contract, supported by a bank. Then you say that okay, it doesn't matter whatever may be the price after 6 months of the dollar, I will still pay a constant currency, and to protect that, I will pay a premium to the bank. Meaning, for example, you need $10,000 to pay some consignment and all that after 6 months. So now the dollar is 52. Okay, so basically you have to pay 5.2 lakhs. So now after 6 months, the dollar might go to 55, so that your payment will become 5.5 lakh, right? But you want to pay 5.2 lakh. So you get into a contract, fix the value at 5.2, right? 52. And if the price goes to 55, you still pay 52. So who will take the hit? That speculation is coming through a premium to bank. So those concepts are built into F&O. But stock market F&O is totally different. So, I mean, not totally different. The concepts are used, but in a different way. Then suddenly, the financial institution came and they thought, it is another area to make money. Okay. So let me come back to stock market, because we don't want to get into future contracts. And see, Zero Diversity is a good place to understand many of these things. Please do that. Okay, the future options. So, but I see my job. I'll tell you that, okay, how future options, what I have observed. Okay, so I'm not a very option kind of guy and all that. See, both are leverage instrument. Correct. So what is leverage instrument? Basically, you don't pay that price of the value. You just pay a portion of it and still own it temporarily. Okay. Meaning that, okay, if you are buying a stock for 100 rupees, if you're buying a delivery, then what happens? You see, if you're using a discount broker, then you have to deposit 100 rupees in ledger, then buy that stock, you get a contract note and the stock. Right. Now, in case of future option, you don't pay 100. You can pay 10 rupees, 20 rupees, 5 rupees. That's called margin. Right. So now when you're buying at 10 rupees and getting a 100 rupees value, right, the profit and loss is coming both from the underlying value, that is the 100 rupees. So if you gain 5 rupees on 100, that might be actually a 5% gain on the underlying value, but your capital is margin, so 10. So you make 50%. So that's called financial leverage. Right? So this is one basic nature of future options. So then the second fundamental difference is futures does not have a time element. Options do have a time element. Okay, meaning that, okay, futures just mimic the underlying instrument. So for example, if the Nifty futures, right, they'll mimic the Nifty index. There will be slight premium, because of for the roll forward. But when it comes to option, there will be strike price, there will be put option in the money. I mean, you can get all this theoretical information from zero. I am not going to repeat that. And in the first place, also that, okay, I'm not an expert in future options. See, this is what I understood. Option in India has become a low premium drug. Okay, so option is attracting those guys, who are undercapitalized. Otherwise, nobody will take two elements of risk, right? See, if there are variables, which says that, okay, see, when you buy or sell a stock or a future, right, you don't know the direction. That is for sure. So that speculation, nobody knows. It can go up and down. That's what we are taking the chance, right? We are doing a probability. But now, if you add another element, say that, okay, this premium will expire, in such and such date, and become worthless, right? You are adding another element. I don't understand that. Okay, why should you take another risk on another element unless there is something else, and that something else is capital. So in short, depending on the strike price and the expiry date to which you are coming in, right, your premium can be substantially lower, which is not available. So, for example, in practical terms, if you want to buy a Nifty future contract, I think 75, 80,000 rupees, whatever Zerodha takes. I don't use Zerodha, so I don't know. You can check it out. So mid cap Nifty, I think last time I bought it was some 75,000 rupees per contract, right? So meaning the lot size is 50. So with 13,000, it is 6.5 lakhs rupees you are buying for 75,000, 12% around, right? Now this 6.5 lakh, you can hold it at a 6,000, 10,000 premium also, in options. Okay, that is the crux. But it does bring that, additional time element. So now here is the ground reality. Most of the options, they expire worthless. 99% of them. So it is the people who wrote those options, largely financial institutions, they make premium on a high volume. It's very seldom, the small percentage of 0.5%, 1% people who made tids and bits of money again, in that space also you're fighting with the financial institution. And I'm not making this up. You can read SEBI report. Don't read the headlines. Read their charts. Read the money flow. You will realize that, okay, the entire money from retail has been taken away by the financial institution. They have given the name also actually. I mean categories. And you'll realize, they specifically mention also that okay, this technological advantage of theirs, right? Whatever you call, algo, quant, and all that, they don't use these normal systems, so they have bulldozed in these areas. So I don't think you have a good chance to fight with them there. This is my opinion. And if you are well capitalized, I need a leverage. I don't need a time element. So most of the time I use futures because I don't have a capital problem to my appetite. Okay. So this is the fundamental difference. Okay. Now the second is that okay, as I said that okay, how do I feel about the futures, trading and all that? See, there are two types of instrument. One is index, right? Nifty, mid cap Nifty, finance Nifty, right? Bank Nifty. Then second, individual stocks, some 240 odds. I think they have their own future options. So this is for sure that okay, that individual stocks have a higher volatility than index. Okay, that means individual stock can go 5%, 6% down and all that. Index very rarely goes 5, 6% in a day on some specific events and all that. So what makes you scary or shaky is your size. If you are holding a hell lot of size, or a very big size, then that makes you tricky and scary. But if you're holding in a very nominal size and all that, doesn't matter, whatever the fluctuation is, you won't bother. But again, if you don't have a proper size, you won't make money also. So it works both way, right? Second is that okay, when you what is my experience is that okay, don't try to predict too much of market in futures. Just hold on, with the money management and risk management till the time it favors you. See the market cycles and and bit of understanding about macroeconomics, it helps. But when it execution happens, it's totally different. Focus on one instrument, manage the size, and then wait for your direction to come up. It can be bone chilling, it can be risky if you can't take the hit. Cut down your size. These are the kind of things required. So you focus on that. Okay, how you are going to keep your size while optimizing the profit while dealing with future options. Not that some goddamn indicators going and up and down. They don't help. See, you might be thinking that okay, I should talk something about specific entry exit formula and all that. The point is the answer is none. Even if you make 20 types of entry exit formula, they just don't work. It is how do you buy or sell, then short sell or long. How do you carry forward them? How do you adjust that? How you're managing or maneuvering through that period. Because eventually if you realize that okay market will go up and down. So for example if you are short now, which I am, it will fall at some point of time, but it will not fall the time I want. Before it falls, it can go up 10%. Before it falls, it can go up 8%. Right? So now I want to, what I am looking for a solution is that okay, I want to time it perfectly so that okay, the time I bought it will fall down. Answer is it's impossible. Okay, some people might say 90% accuracy, you go and fill and try, that doesn't work. So basically, you take a stab based on some of your understanding that okay, you will say that okay, probability, the market is going up, for last n number of days and all that. I think this is the time to fall. Or you second thing is that okay, you say that okay, the fall has started now, it is consolidating, probably it will further fall. Whatever your probability theory is that okay, then you come and do the short or long. Hold it for a period, where you can tolerate. So reduce the size, increase the size, because they work over a period of time. They don't work, with a click of a button. Today I buy, then after 15 minutes it starts falling or going up. No, they don't work. Okay, so don't open these candles and stupid things, in the daytime and saying that okay, I'll put it buy here, sell it here. I mean, this is not how I believe. If you want to make big money out of future options, go for decent size of contracts. You might go wrong or right, you amend them, adjust them, then be in the trade. Okay, till the time you see that okay, how the trade is working into your direction. If it doesn't work, then take a humble pie, save your capital, come back and fight again. Don't make it too complex, of mumbo jumbos and entry exit methods and all. They don't help. I know that, okay, I'm not giving you any specific. It might making you bore also. I don't know about it. But what I'm saying is, the ground reality, what I have felt, these are the truths. So if you are a self-made trader, or if you're a trained trader, right? I'm a trained trader from because of my employment experience, and I'm doing on my own. So I'm sharing my opinions and my experience. It might be go right or wrong, but large part of the my domain, large part of my circles, I have seen we do the same. Okay, then you do yourself, and if you're making money consistently, and you how do you know you're making money consistently? Not by one trade, two trade. I told you about the metrics. So if you have find out a trading style, trading philosophy rather, I would say, over a period of time, which is giving you consistent profit year after year, then you're good. But again, I've been doing this on and off. I have never found these technical indicators and all that. They're helpful beyond a point. So it's that the probabilities, the small little probabilities, and understanding of macroeconomics, they work well for future options. And then you adjust size, till the time the position goes into your favor. Sometimes it does, sometimes it doesn't. But over a period that you honed your skills, right? You know that, okay, maybe this is too early. This is not the right time in the market cycle to come and short. Let me wait. Let me see whether the market become more overbought. So these kind of probability requires this drawing a line, this resistance support. Market doesn't bother about anyone. I mean, if you want to really know about these things, even read reminiscence of stock operator. So there's an incident, where Mr. Livermore was sitting in some broker office. The broker is saying, this is the support level beyond which it will not fall. So Mr. Livermore said, okay, you draw a line, I'll show you how it falls. Okay, so now when the prices come out the support level, suddenly he sold some million quantities. It just ripped through that support level, came down by 5%. See, as long as there is a seller and buyer at any price, none of these levels are going to work. So they are psychologically sounds good and all that. And practically they can work, they cannot work. So don't depend too much on them. Be go there and prepare your own mind. Think that, okay, rather think that, okay, how can we see the small secret formula I have seen to survive? I can't say about see, to make big money, you need to have big capital. Either you make this capital from your family wealth and all that. I don't know if you have it, it is fine. Or large part of these people actually they have taken money from others and built it. So Warren Buffett is more not an investor, more actually a businessman. The way he raise capital and allocate capital is amazing. Who will give you that capital with salaries and all that? You don't expect to pump a hell lot of money. So try, so the money comes, you try to manage others' money, or you're doing some other business, right? Or you're trying to what you call coach people, sell product and all that. Then you get that money reinvest in the market. Right? So or be content with whatever you have. There's no logic of going by the fantasy stories people are telling you on YouTube or wherever that, okay, be a trader and make grow. I don't know, they might be working, but I mean, this is what my opinion is all about. If you held the trade for a period more than what you have planned, your chances of success are higher, because the more the time you give it to the market while managing your risk, managing your capital, the success rates are much more higher. Okay, not by cutting out. See, cutting out is nothing wrong. Cutting losses is important, but cutting meaningless losses also is useless. So that is always a word called optimization, right? So that optimization is a philosophical thing. You have to go there and learn it by yourself. Okay, I'll leave it there because I think the market is going to open in 1 hour. Take care of yourself. I'll try to come in next time. Goodbye.